Hello, you are welcome to Maths and Actuary with Shadrach. Today we'll be looking at the Financial Mathematics Exams syllabus, that is exam FM. Basically, there are three broad categories on which the Financial Mathematics examination is based. So we have one, time value of money and annuities. Second category is loans and bonds. And the last category is general cash flows, portfolios and immunization. So these are three broad categories that any questions on the FM syllabus will be based on. So if you are a student preparing for your first actuarial exams in financial mathematics, I would encourage that you have studied and mastered these three topics. Today being our first time, we will take a look at time value of money. So that is one topic that it is of interest to every student who wants to pass their first actuarial exams. And I personally say that time value of money is one topic that in financial mathematics, any of these topics are based on. So your foundations in time value of money will tell how well you would understand concepts like annuities, loans, bonds, and even general cash flows. In this section, we will take a time to look at time value of money. So I'm quickly going to wipe this out. If you haven't yet written it, kindly pause your video and write this topic somewhere as I wipe them out. Under time value of money, the first topic that we'll be looking at is interest accumulation. So we'll look at one, what is interest, and then we'll look at two perspectives of any financial transactions, and we'll look at the amount function and accumulation function. So the first question that you have to understand or should be able to answer is, what is interest? Funny enough, you wouldn't be asked questions like what is interest rate or what is interest accumulation, but understanding of the concept behind interest helps in solving problems. If you don't understand what an interest or what interest is in financial terms, you have a problem passing exam FM. So first, let's look at what is interest. So you can look at this scenario. Before I give you the formal definition for interest, let's consider this scenario. Let's say today I deposit 100 cedis or dollars in a bank, and a year later my account is worth $110. You could see there is an additional $10 that has been added to my account. Refer to it as the interest earned on your deposit or on your investment. So you can look at interest as in maybe you are lending or you are giving out an amount to the bank, and the bank is using it to do anything, and they are compensating you for using your money. So in most financial terms, they look at interest as the rent for lending money. So if you lend 100 to a friend and the friend pays you 110 after a year, that difference of $10 is what is referred to as interest. Let's look at some terms here that we would be using throughout. Your interest, which is I, is the accumulated value minus the principal. Okay, minus the principal, where the principal is your initial investment and the accumulated value is the value of your accounts after some number of years. So simple, interest is the compensation a borrower of a capital pays to the lender for the use of the capital. And as I said earlier, every financial transaction has two perspectives. Either you are looking at that transaction from the perspective of the lender, or you are looking at the transaction from the perspective of the borrower. Suppose you deposit into a bank, you now become the lender, and then the bank becomes the borrower. But on the other hand, if you go in for loan from the bank, the bank becomes the lender and you become what? The borrower. So if I'm approaching this type of financial transactions, I can look at it whether standing in the position of the lender, or I'll look at it standing in the position of the borrower. All right, let's now look at the amount function. So somebody would ask that, why do we need the amount function? So the amount function is very, very important, because with this function you can find the accumulated value or the future value of any initial deposits at any point in time, right? So suppose you deposit, let's say $100 today in a bank, and you want to find how much the account will worth in 5 years from now, 10 years from now, in 10 years from now. You need what we call the amount function. Let's assume that this is possible, that when we are given the initial principal or the initial deposit, we can find the accumulated value of that amount at any point in time. So at any point in time, it is possible that we can find the accumulated value of our initial deposit. So let's now look at some 3 properties. So the first property of the amount function is that if you evaluate the amount function at time 0, then you get your initial deposit. At the moment you invest and you evaluate the function at that point, you only have your principal as your return, because at that time there is no passage of time where you can say maybe my account is now after some number of years. But at the moment where you deposit, the accumulated value will still be your initial deposit. The amount function is an increasing function, and this is true if you are considering savings, right, or bank savings. We are not looking at a stock investment and all those things where the stocks could rise or fall at any point in time. So this expression says that for all t greater than 0, a at t I is less than a at t j, provided I is less than j. And this is what it means. It means that if I invest 100, if I invest, let's say 1,000 now at time 0, okay, if I invest 1,000 now at time 0, at between time 1 and time 2, I expect that because a of t is increasing, I expect that the amount that this 1,000 will accumulate to in 1 year should be less than the amount that 1,000 will accumulate to in 2 years. So suppose this 1,000 accumulates to 1060 at the end of year 1. Then at the end of year 2, probably the amount should be at least 1060 or more than this, right? So this should be something like 1090. So the last property of the amount function is that if interest accrues continuously, then the function must be continued. And finally, one thing that I would love that you keep in mind is that the formula for finding the interest earned for any period is given by, so the interest earned on any period is given by a of n is equal to the amount at time n minus the amount at time n minus 1. So if I want to find the interest earned on a period, it is the accumulated value of that account at the time n minus the accumulated value of the account 1 year before that period. Okay, so on the timeline, if I want to find the interest between time n minus 1 and time n, suppose an amount here is a1 and an amount at time n is a2. So the interest earned on the period between n and n minus 1, which is I of n, will be equal to a2 minus a1. All right, so let's now look at the accumulation function, right? Let's now look at the accumulation function, which is represented as little a of t. So the accumulation function, somebody will say, if you are using the amount function, why then do we need accumulation function? So the accumulation function is the special case of the amount function where your initial investment is just $1. So accumulation function, so little a of t is equal to upper a of t, where k, which is our initial investment, is equal to 1, right? So the accumulation function is equal to the amount function when k is equal to 1, when your initial investment is 1. And the same property similarly holds for this. The property for a of t, small a of t, is that little a at 0 will not be equal to 1. Whilst if you have little upper a of 0 is k, so when k equals 1, then we have little a of 0 equals 1. Basically, this is all about the interest accumulation lesson part 1. In the next video, I'll be solving questions where we will take our time to understand the concept. So this is just intro. Make sure you go through the concepts and then let me know the questions that you have on board. So I would address them, solve more questions to explain more things to you. Thank you very much for staying behind. Please, if you have not yet subscribed to the channel, kindly do so and turn on the notification bell so that anytime we upload the video, you don't miss out. See you.